2017 has been off to a positive start here on Wall Street. We've seen the U.S. equity averages inch slowly higher. Joining me now is Keith Bliss of Katona & Company. Keith, Happy New Year, and thanks for joining me today.
My pleasure, Remy, and Happy New Year to you.
Well, this isn't a traditional January where we just continue to eye the factors that affected the equity markets in the previous month. We do have continued expectations for the Fed Reserve and for the new administration. But this month, are you eyeing a January effect at all?
Yeah, I think so. One of the things that I think we'll see, maybe not in the first week, but the second, third week, is you're still going to have the retail investor coming back in and chasing this market a little bit. There's not as much bonus money floating around this year as there were in prior years that had to be put to work in January, but you still have mutual fund complexes and other institutional investors that certainly did some tax lot selling at the end of 2016. Now they have some cash inside of their coffers. They'll be putting that to work. So that's where a large majority of the move will be. And again, if you believe the narrative that we've been dealing with since November 8th, that this will be a pro-growth administration, consumer confidence, and those indicators are up substantially. If we get other pro-growth types of initiatives like tax reform and a reduction in the regulatory regime, then U.S. equities is probably going to be the most viable place to put your money, and I think we'll see that play out this month.
Well, Keith, taking a step back, we started the new year with a handful of PMI manufacturing figures from around the globe. We also got Eurozone inflation figures out earlier today. So given that we have the jobs report coming up at the end of this week, have you changed your expectations at all based on any of the numbers?
Not yet, although it is something that we do need to keep an eye on. The one risk to any positive thesis that you find out there about equities being the place to put your money is what happens if inflation creeps into the economy at a little bit faster pace than everybody expects. The Fed has already signaled that they're going to raise 3 times in 2017. We get the minutes out later today, which should give us some more clarity on that front. But if in the pace of inflation, and you're right, the ISM number was a big number in the manufacturing side relative to input costs that we got yesterday. If the pace of inflation quickens, then the Fed will be forced to move and try to get ahead of it, and that could be the one thing that could dampen this rally inside of equities. But again, 1 month does not a trend make. Therefore, we have to keep an eye on it with each passing inflation data point. And I think that's where the focus will be this year more than any place else.
And indeed, Keith, we do have to keep an eye on the time frame when we're looking at these economic data points. I know that you also watch interesting indicators in the commodity space as well as other indicators as well. We did see wild swings for oil as we head into the new year, but what are you watching right now?
A lot of the commodities, because the commodities are really going to dictate what the inflation picture is going to look like. If you look at the ISM, the picture that came out with the ISM, the main inputs that went up substantially were steel, aluminum, copper, and those are, when you take a look at finished materials, finished industrial materials around the globe, those are the 3 main inputs that go in there. They went up substantially. We still don't have them overbought at this point in time, and copper would have to rally pretty dramatically to get to that point. But again, it's a trend that we need to watch. So that's the one thing that I'm looking at. Gold still has quite a ways to go too if you're talking about commodities, and I'm not sure gold is going to be the play, because gold is generally a store of value if people are nervous about things going on in the globe, and right now people don't seem to be nervous about things going on in the globe. The one thing that I would look from an indicator or correlation inside of the market right now is the equity indexes, the major indexes, have basically been moving sideways since the beginning of December, and we're seeing that play out again this month. The only one that hasn't been moving sideways is the transportations, and the transportations are starting to trend down. Transportations generally lead the Dow in whatever direction they're looking at. So I want to keep an eye on that to see where that's going to play out over the next 2 weeks. The other thing to look at in oil is don't be fooled by the run-up in oil prices right now. Oil is in a pricing mechanism, what we call backwardation, which means the spot price is higher than the futures price, therefore meaning that people are going to take advantage of that right now. They're going to lower out their supplies in anticipation of lower prices going forward. So you need to keep an eye on that. It doesn't mean anything about economic growth or economic development. It just means that people are unloading their inventories. So if we see that normal out and the curve gets back to a normal level upward sloping curve, which is known as contango, then the oil story will play out. So those are the major themes that I'm looking at right now.
Well, Keith, we'll keep an eye on those levels and we'll get back to you on those prices when I speak to you next time. So thank you very much for joining me today and have a happy and healthy start to the new year.
My pleasure. Same to you.